Let's go back to interest rates first. What do we think about the way the market's looking forward on the cash rate?
Well, if the market thinks the cash rate's going to 2%, I mean, that's very bearish. You know, at the depths of the global financial crisis, our interest rates, our official rates didn't go that low. So notwithstanding what Mr Power just said, you know, like the market is telling you things are going to get worse. And Roger and Miller, as you know, I mean, people say in recessions you should always look at the bond market. The bond market gets it more right than the stock market. And the bond market is telling us that interest rates are going to be cut. But I guess for me the issue is, I mean, if we have a banking crisis, even if the RBA cuts rates, how much of that could our banks actually pass on to customers? And I don't know that there's much more they can do.
Well, this is the thing, because, you know, you saw Bernie Brooks from Myer complaining again this week that the rate cuts just had no impact on their customers. People still aren't buying. But I do wonder, though, I mean, there was a Boston Consulting study the other day showing that Australians feel more uncertain about their financial position than Greeks and Italians. I mean, that's a little bit crazy, isn't it?
You look at the US, and low rates there have not triggered enormous growth. Once rates are below a certain level, cutting them by 25 basis points or 50 basis points is neither here nor there. If people have zipped up their wallets, that's it.
But also there's a lot of losers when rates get cut as well.
Well, absolutely. And my big concern is for retirees who are being advised now to get out of the stock market. The stock market's too volatile. Rates of the returns have been low. I think the All Ords has gone nowhere since 2007, and so therefore you should be in some products that are going to give you yield, which is what you need to eat and so on. And yields are terribly low. What I know, though, is that over time, when you've got low interest rates for long enough, and depends on how long this deleveraging cycle takes, it could be a decade, but when you've got rates low enough, eventually you get reinvestment, and that eventually happens. But it could just be a lot longer this time around because we're artificially supporting banks globally.
Just while you're talking, what do you think of Nev Powers on the subject of iron ore? What do you think of his $110 a tonne budget?
The fact that we actually care what these people are forecasting iron ore prices just goes to show how little we've actually learnt. Between 1985 and 2004, the iron ore price went, I think it ranged between $11 a tonne and $15 a tonne. Nobody in 2004, when the iron ore price was $14 a tonne, was forecasting $187 a tonne just 3 years later. And at $187 a tonne, no one was forecasting $100 a tonne. And so what we find is that we've got this massive supply response from the high prices. So we've got investment response, which is a natural commodity cycle as a result of the high prices. But the reality is that what we're going to see now from this supply response in the Pilbara region times 2 is 700 million tonnes of additional supply, and China's not going to need that much. Prices will come down, and they'll go further down than what people think.
Well, one of the things I reckon, it's a bit like, I remember in the dot-com boom, the government moved to create a new class of visa for IT workers, just as the demand for them fell apart. I wonder if the resources tax, particularly the iron ore coal tax, because that's what it is, it's the same thing. The government's finally woken up to how much money there is. They say, let's tax it. That could be the turning point.
Nabila, one of the big stories this week was the demise of the Hasty Group, the engineering services company. I'll get you to talk about that in a moment, but we've got a package from Kate Tozer on that subject.